Today, folks, I am holding 2,465 shares of the Schwab US Dividend Equity ETF, ticker SCHD. And as a Canadian, I hold this within my Registered Retirement Savings Plan, my RRSP. And the reason I hold this dividend paying ETF in this account is as a Canadian, when I buy US dividend stocks, the government in the US says, hey, we're not just going to throw you money made in our country over the border to you for nothing. We actually want to charge you a tax, and they call it a 15% withholding tax. And I'm not sure how it got worked out, but in this specific tax sheltered account, we can receive that dividend without paying that 15% withholding, allowing me to either reinvest it or take the dividend and pay it out to myself. And coming out of an RSP, I would have to pay my marginal income tax rate. However, I want to break down this current position. I have an SCHD, the performance in the recent reconstitution, as we take a look at the top 10 holdings and what the ETF currently looks like and how I feel about it. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe button, because recently SCHD has been lagging the S&P 500, and I do not consider this to be an all-encompassing ETF. I would not put all my eggs in the SCHD basket, because in moments like we're seeing now, you know, the S&P 500 is starting to realistically outperform by a pretty large margin. And the reason I believe for this has to do with the interest raise cycle. Typically, dividend stocks are traditional companies that tend to have more debt. A lot of them are infrastructure-oriented companies, and typically in higher interest rate environments, a lot more of their net income is starting to get allocated toward debt. Whereas these S&P 500 top 10 companies, as we like to call them, the Mag 7, are very resilient tech companies that have a lot of cash on their balance sheet. And even some of the upper-weighted U.S. companies are banks, and banks tend to have a lot of cash, so they tend to make more money in higher interest rate markets. And we're starting to see this disconnect, whereas historically SCHD actually kept up with the performance of the S&P 500. And something tells me as we start to see interest rate cuts in the US, we should start to see better performance out of some of the holdings within this ETF. But the reason I hold SCHD is primarily for recessionary environments, even like the ones that we're kind of seeing where the markets get a little bit more volatile, because as we can see through 2022 when the interest rate cycle started to begin, we can actually see SCHD kept really incredible performance, and it allowed me to collect a dividend when the S&P and tech companies were underperforming, giving me money to reinvest where I see fit. And I really like having that kind of balance of income and growth, because it really benefits in both market environments for better and worse. If we take a look at the dividend, the current 5-year growth rate has been around 5.51%, which has actually been slowing down. If we take a look at the dividend history, we can actually see over a 10-year period, the growth was quite astounding. I mean, from 9 to 10 cents a quarter to anywhere from 27 to 26 cents a quarter. The growth was absolutely astounding, but it is starting to tamper off a little bit, especially in the tougher market environment. Makes some sense. Now, before we break down the top 10 holdings, let's talk about this guide that Seeking Alpha offered, kind of just updating what's going on with SCHD, because as the summary is told, SCHD's index reconstituted at close of business day Friday, that was last week, resulting in 20 additions and 17 deletions. The index deleted Pfizer and BlackRock, while the additions are ConocoPhillips is SCHD's new top holding. The total energy sector exposure is now 20%, which raises some concerns regarding dividend growth and consistency. And my backtest reveals the new portfolio is designed for high inflation years like 2022. SCHD's index yield dropped by 0.07%, and shareholders should earn about 3.81% at the current prices. Importantly, SCHD retained its quality, value, and dividend growth advantages over other dividend ETFs. However, weak sales and earnings growth reminds us SCHD is not perfect, and investors should seek complementary funds. In addition, SCHD's high 63% dividend payout ratio was a big disappointment. I don't think that's really that big of a disappointment. A healthy payout ratio is usually 40 to 50%. 63 isn't like nosebleed levels, right? SCHD's index reconstitution reinforced my reasons for keeping it as a long-term investment. However, I'm hesitant to back up the truck due to earnings growth and dividend safety concerns. Therefore, I am assigned it a solid hold rating. And they do break this down much farther, but we'll take a look ourselves, because essentially the rules behind how they pick stocks I always find very, very interesting. And I want to read this to you just real briefly. Is all index eligible stocks must have sustained at least a 10-year consecutive years of dividend payments and have a minimum float adjusted market capitalization of 500 million US and meet minimum liquidity criteria, which is just how much stock volume and how many people are buying and trading the stock. The index components are then selected by evaluating the highest dividend yielding stocks based on 4 fundamental based categories: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks in the index are weighted based on modified market capitalization approach. No single stock can represent more than 4% of the index, and no single sector as defined by the index. Now, I find this very fascinating because I love these rules, because we look at rules like this as a place of security, safe haven. And again, if you are in retirement, I feel like these are the kind of ETFs people would be looking to attain. Now, unfortunately, if I were to scroll up and break down the ETF's fundamentals, the payout ratio has not changed, but we can't actually look at the fund characteristics anymore because they haven't been recently updated. The last update was 02/28/2025. I find it a little annoying that the ETF can update the holdings, but then we don't get sector updates or these fund characteristics, so they're kind of useless to look at, even including the dividend right now. But what I'm going to do for you is just briefly scan over the top 10 holdings, then we'll take a look at the lower half of this ETF just to see what these stocks are doing, because we have ConocoPhillips, Chevron, Bristol Myers, Verizon, Amgen, Merck, AbbVie, Coca-Cola, Altria, and Cisco, some of which you may have heard of, some of you might not be familiar with. We'll kick it off with the top holding, which currently makes up 4.53%. First and foremost, a company I'm not that familiar with, even though it's a $132 billion market cap company, 13 PE, very reasonable, and a 3% dividend. I do understand that these are in the energy sector, and the energy sector, I'm surprised, has been holding up as well as it has been, because oil has been retracing for over a year now, and typically that hits oil companies, but oil companies tend to have fairly consistent revenues, but it's completely dependent off what those oil prices are doing. And obviously oil prices coming down mean revenue is going to come down, net income is going to come down. And this isn't a period where I'm overly excited about the energy sector, right? Even Chevron's trading up 12-13% this year, $300 billion company, 17 PE, 4% dividend yield sounds great, but again, we're not talking about major growth. In fact, the revenue has actually fallen off. Surprisingly, net income has dropped quite dramatically, and the revenue here has started to come down thanks to oil prices retracing. So I'm not sure what the excitement was to reconstitute heavier into energy stocks, but again, I'm not like overly concerned about this, because energy, though is cyclical, is a very stable place to generate income. Now, speaking to the more medical side, biopharma, healthcare, I think this is one of the most intriguing sectors to be a part of, because this is one of those more recession proof, and I guess you could say energy is more recession proof as well. These are required regardless of market conditions, and Bristol Myers is actually up 7.5%, 4% yield. If we take a look, revenue, I guess based on recent factors, new drugs, whatever's going on with the company, is actually trading up quite nicely. And if we actually take a look at how that revenue's equating to net income, it's not. So it looks like they're kind of reinvesting all that money. I'd be curious to see where it's going, but net income doesn't look great right now. The last few quarters, they've been spending more than they've been actualizing. That could have to do, obviously, with depreciation and amortization costs as well. I'm not sure. I'm not a medical expert here, but what I do understand much better is, obviously Verizon. I think everybody can understand Verizon quite well, telecommunication company, and has actually been in a recovery play over the last couple years, and even year to date doing quite well, up 8.47%, very healthy PE, dividend yield at 6%, very reasonable company with very stable revenues. And if we take a look at net income, we're talking about net income that's been a bit more dodgy. And again, my speculation is this has to do obviously with infrastructure, higher debt payments, but we are seeing net income recover here on the last quarter, which is quite intriguing. And I do like this sector for stabilized income. In other, biopharma, healthcare sector, we've got Amgen, which is now up 20%, being one of the best performing stocks probably of 2025, but 3% yield, PE all over the place, but revenue is absolutely exploding here. Seeing double-digit revenue growth over the last couple quarters, with net income actually falling off as well. And I'd be curious to see where the net income is going in these healthcare companies. Again, a lot of this might be getting put into new drugs. These are companies that tend to be a bit cyclical, as drugs in the US typically have a certain lifespan before the patents run out, and then they can become mass market drugs. But really neat to see that their growth is absolutely exploding on these companies though. But if we take a look at Merck, Merck is one that's actually been trading down 8% this year. This is another major healthcare company. Very reasonable PE though, dividend yield very reasonable. So the net income should be fairly strong, as Merck is seeing, mid-single digit revenue growth, very stabilized growth, with net income actually recovering quite substantially here. And this is probably why the PE looks so reasonable, because the last couple of quarters have been net income all-time highs. And again, this is typically what investors want to see, right? Like they want to see very healthy net income, very great stable revenue growth. You get all those boxes ticked along with share buybacks, which is something they haven't done as of recently, but those are like the three formulas to a great growth company, right? Is you want to see share buybacks, net income growth, and revenue growth. And I'm not really going to dive into all of these companies to see where they're at with that, but it is something you can take into consideration with your own due diligence. If we take a look at AbbVie's up 14%. You can see most of the top weighted holdings in SCHD are more or less healthcare companies, which is something that makes me sleep very comfortably at night, because healthcare is proving very resilient here, with again seeing some revenue growth come back here. If we take a look at earnings per share or net income has been actually flatlining to the downside, and it seems to be a trend across all these medical companies, and I'd be really curious to see why and or what's causing that. But still, so long as revenue's going up, I think these companies have a lot of money to play around with regardless. But shifting into a Warren Buffett favorite, Coca-Cola, company paying about 3%, PE is a little bit higher. Another company up about 12% on the year, seeing revenue start to recover quite well from the lows that it experienced before the pandemic. So the company is doing all the right things to get revenue growth to come back, regardless of that being new product releases or just increasing prices. And net income very, very stable, something that I'd prefer to see, and something that's likely being bought back in shares as well. So this company checks all the boxes, which is what I like to see in companies. We got a couple left here, with Altria Group being my least favorite of the bunch. I'm not sure how this one fits in over Philip Morris or British American. I mean, obviously that's to be part of the Dow, so British American Tobacco might not apply, but I'm not a fan of the sin sector. Well, specifically MO. I do like the broader exposure in the global markets, but the Western markets that Altria has exposure to have been slowly deteriorating as smokers are actually seeing double-digit declines. Is the younger generation doesn't seem to want to smoke like they used to. But I mean, this company's currently got a great PE and a great dividend, but they're fighting a declining back-end business by trying to increase prices, and even trying to increase prices have not really stopped the revenue decline that they're starting to experience. If we take a look at net income, we are seeing a net income incline, and something tells me this has to do with share buybacks, and again, them trying to squeeze margins out of what they have left. Yeah, you can see they've been doing very increasingly share buybacks to make the earnings per share, net income probably look a lot better than it used to, because earnings have actually been growing. Again, I know that SCHD is just following metrics that actually tick the boxes if we look at some of the fundamentals of MO, but as a business oriented investor, I want to see where the future is going, and I just don't think the future is that bright for a company like Altria Group over the competitors like Philip Morris or British American that have broader exposure, where smoking is still actually inclining in some broader markets. Finally, we have Cisco Systems, a digital technology company, communication company here that is actually doing quite well. It's green this year, pays a reasonable dividend, PE is a bit high. Overall, revenues are very stable with this company, meaning net income's probably fairly stable, actually going down in the recent quarters. Be curious to understand why. And I'm not sure how much of this plays into debt, new investments, but these companies, again, have some cyclicalities to them that we're starting to experience. But other than these top 10 holdings, I'm also very happy with the lower half of SCHD, because if we look at the bottom 10, which still make up very sizable positions at about 3.75% with Pepsi, you got Texas Instrument, Home Depot, Lockheed Martin, UPS, EOG Resources, OKE, I'm not sure what that company is, and a few of these I'm not too familiar with. Kimberly Clark, I'm very familiar with, but Ford Motors, I'm sure most people are familiar with. General Mills, Hershey's in here, but these are much lower weighted because now we're getting below 1% weightings, and I'm not sure exactly what new companies were added in the lower half, but overall this isn't the biggest change that we've seen. I think the last reconstitution saw a much higher turnover of almost 50% of the ETF. But again, I'm still very satisfied with where the ETF sits. Again, it's one of these companies that you can buy if you're looking for stabilized income, which is all I'm looking for in my registered retirement savings plan. As somebody who wants to retire early, I'm looking at utilizing this ETF when I'm in a lower income bracket to be able to pull this out of my RSP and actually utilize that income without having to sell shares. But again, it is only a strategy of a total return investor, as I am now buying XEQT, and I do have a lot of growth stocks, including VOO and some individuals within our accounts between the wife and I. But I will pass the question off to you. Do you like the recent reconstitution? Are you a fan of these top weighted holdings? Are you buying SHD? I'd love to hear about all of it in that comment section below.